Hi everyone, this is Steve Elwell, the partner and chief investment officer of Level Financial Advisors, and this is your first quarter 2021 commentary. So let's jump right in. Another good quarter for the stock market as cases in the U.S. Have been generally trending downward and vaccination rates have been trending upward. And the stock market has continued to reflect that optimism that the economy will continue to reopen and start to get closer to normal. And a lot of the economic data points have confirmed that that is starting to happen here over the last 3 months of 2021, the first 3 months of 2021. So when we look at the stock market specifically, we see that U.S. stock market is up about 6.35%. International and emerging market stocks did a little bit worse than that, but still positive. Global real estate had a good quarter as well. And the bond market actually had a pretty bad quarter. We're going to talk about that a little bit later, but a little bit of a rough quarter for bonds in particular. Now keep in mind they had a fantastic 2020 and 2019, so giving back a little bit of the profits that had been earned on that side of the portfolio. This first quarter had one major piece of news come from Congress and the President and the new administration as they passed the American Rescue Plan, which if you have tuned into some of our other video series over the last couple of weeks and months, you would have seen all the different benefits that are coming out of that particular piece of legislation. So that would include extending unemployment benefits, expanding child tax credits and deductions, another round of stimulus payments and expanding who receives the stimulus payments, money for local governments and states, vaccination money to support the rollout. So sort of a whole bunch of different things built into that legislation. And if you want to look for more detail on that, you can hop over to our YouTube page or subscribe to our YouTube page so you can see the videos that we put out on the specific parts of that particular piece of legislation. That was certainly another piece of good news that the stock market was glad to see happen and helped generally things move upward over the first 3 months of the year. If we look a little deeper into how specific asset classes did for the first quarter of 2021, we can see that again, U.S. small cap value stocks leading the way for this quarter with a 21% return. Value stocks also did well, not just in the U.S., but outside the U.S. Real estate, as we already mentioned, particularly in the U.S., did well. Not that anybody would complain about how the S&P 500 did this quarter, again, returning somewhere around 6%. So in general, tilting a portfolio towards small stocks or value stocks paid off in a really strong way for the first quarter of 2021. So that's obviously a positive generally for our portfolios and our clients. You know, if you tune into these commentaries regularly, you would know that last quarter we started to speak about how that sort of side of the stock market really perked up in the last 3 months of 2020. And we showed a little bit of information just sort of about the disconnect between U.S. large growth stocks and U.S. small cap value stocks as this gap between the performance of the two really started to get stretched. And we noted that generally those things don't last forever. I believe the quote was, "The trees don't grow to the sky." No one investment category outperforms the other or all others forever. If that happened, then there would be no investment world, there'd be no investment markets. We would all just simply buy that one thing and call it a day. So of course we know it's not true that one thing will always outperform. And that's really what we saw this quarter. I mean, U.S. large growth stocks were certainly a big laggard relative to the S&P 500, relative to small stocks, value stocks. Really the outperformance has shifted. The trends have changed in a pretty strong way and pretty quickly. In fact, I have a quick chart. I showed you this one last quarter. Now I want to show, this has to do with U.S. small cap value stocks, particularly the DFA U.S. small cap value fund, which a lot of our clients own. And previously I had shown that fund's performance since the bottom of the downturn in 2020. What I'm showing now is just simply the fund's return over the last 2 quarters. So the fourth starting in September 30th and going through March 31st, 2021, and just 2 absolutely knockout quarters for that particular asset class and category. So you can see the total return of that particular fund over those 2 quarters at 67.82% for 6 months. This kind of reiterates some of the things that we talk about over the long term when it comes to investing. Often investors can run out of patience for certain asset classes if they continue to underperform for a while, whether that's 6 months or a year or even 2 or 3 or 4 years. But in the markets, what's most important when you have a diverse portfolio like this, like ours, is even for those asset classes that maybe have lagged for a while and you feel like are adding no real value to your portfolio's performance, the snapback as to when they might start to provide extra value compared to something like the S&P 500 can happen really quickly. More quickly than you think might be feasible, and more quickly certainly than you might expect. And I think this is sort of a perfect base case scenario of here's something that I don't think most investors were expecting to outperform by that much that fast. And so we like to compare holding on to those type of asset classes to riding a roller coaster, and we steal this phrase from our friends at DFA, is the best results when you ride a roller coaster, the way that you stay safe is to stay in your seat, to not get out, to not move, to not change course. Obviously, if you do that while you're on a roller coaster, that's a pretty dangerous move. The same story with asset classes that might be lagging something like the S&P 500 for months, quarters, or years on end. You don't know when that tide will turn, and you don't know how fast that tide will turn. And in this case, that tide has turned extremely quickly. So I just want to sort of wrap up and give a follow-up on what we had talked about last quarter, because the story has continued to an even greater extent. So that's good news. Good news for those that have continued to hold that asset class. So I want to circle back a little bit to the bond side of the portfolio. Particularly what's happening with interest rates, which from our perspective seems like maybe a little bit under the radar as to what's happening on that side. So as a general recap, our portfolios maintain mostly short-term bonds, short-term high-quality bonds. And we do that because we know a couple of things. We know that from an investment perspective, we need that side of the portfolio to remain safe and not be too volatile, because that's the side of the portfolio that we lean on when the stock market goes haywire like it did last March. And that's exactly what we did last March with people that needed withdrawals, or just simply when we were rebalancing, we took money out of the safe bonds that had not lost money during that downturn. So as I talk about that, generally when you have longer term bonds, the main concern that comes from that, the main enemy of long-term bonds, is really just 2 things. Number one, inflation, which can eat away at the real return of the interest that the bonds pay. And number 2, rising interest rates, which of course make bonds that are already owned with lower interest rates less attractive, because new higher rates are available for those with cash that are buying new bonds. And so when we look at it, the first thing I want to sort of point out is on the bottom right of this fixed income chart here, the quarter to date, you can kind of see that the short-term bonds, for the most part, along with high-yield bonds, were either positive or slightly positive as you look at the short-term pieces. As you start to look towards the bottom of that quarter-to-date column, you see that the U.S. aggregate bond index and the long-term government bond index, between the two, one lost a little more than 3% and the other lost 13%. Interest rates have moved upward as the U.S. 10-year yield went from about 0.95 to about 1.74. So that's about a little less than a 1% increase. And that caused in long-term government bonds a 13% decline for the quarter. And even as you look at the column over the last year, you can see that many of the bond categories were positive, particularly the TIPS category and high yield categories had a pretty good year for the last 12 months. But you can see U.S. government bonds have lost 15%, long-term government bonds have lost 15% over the last year. And that again, if you're going from March 31st, 2020, which is the bottom of the drop in the stock market and kind of the peak of the fear in the investment markets, as you go from that point until today, interest rates certainly have recovered and moved upward over that 12 months, and that has spelled bad news for long-term government bonds. So as I switch over to this JP Morgan chart, and I kind of show on the top right of this, what I want to highlight is the impact of a 1% rise in interest rates for various U.S. government bonds at different maturity levels. And you can see visually what's happening here is pretty clear. The shorter the term of the bond, the less likely it is impacted in the short run, and as prices change, the less the impact on the value of the bond. So if you have a 2-year U.S. Treasury, which is the top piece there, a 1% rise in interest rates might cause the price of that bond to go down by 1.9%. But a 30-year U.S. government bond would cause the price to decline by 19.8%. And even a 10-year U.S. government bond would face a 9% decline if interest rates just rise another 1%, which would get back to levels that we saw before the pandemic started. So what we're highlighting here is the risk that sits out in the bond market should the economy continue to recover or heat up, should inflation start to rise, and should that cause the Federal Reserve to increase interest rates and potentially increase them by a fair amount. That might spell pretty dramatic declines in longer term and even intermediate term bonds. So from our perspective, maintaining that strategy of keeping short-term, high-quality bonds is very important to defend against some of the risk that lies in the bond markets at the moment. This is not us saying that we think interest rates are going to rise by 1%. I don't know what's going to happen with interest rates. No one else does either. But I think with the amount of government stimulus that's been passed, with the amount of economic activity that's starting to resume, with vaccination rates going up, cases of COVID generally trending down, summer approaching, warmer weather approaching, and all these people that have been cooped up for the last 14 months and are now sort of saying, hey, I want to go do all the things that I haven't been able to do now that I can go out and about and travel and visit my kids or whatever the case may be. I think that there is some potential risk on the bond side of the portfolio for those that own longer term bonds, and it's important to be aware of that. So that's part of the reason why we like to maintain shorter term bonds is, that potential risk of rising rates doing damage to the returns of that side of the portfolio is minimized to a greater degree by holding shorter term bonds. So we wanted to walk through that. I also want to walk through one additional piece that we're hearing a little bit about, which is, of course, the stock market hitting new all-time highs and continuing to rise above and beyond that. And sometimes investors sort of say, hey, the stock market's at an all-time high, which of course means it's never been higher than the moment it's at now. Is now a good time to invest? Like, should I still be investing in stocks or depositing new cash to buy stocks when prices are at the highest price they've ever been? And the first thing that I would point out about that is if you took the opposite approach to never buy stocks when they're at an all-time high, well, that would mean that about 80% of the time you are not buying stocks, because 80% of the time the stock market is at or very close to an all-time high. So number one, most of the time, you're not going to be investing any new cash because you will be at a moment where you're pretty close or at all-time highs. Number two, if you took that approach, you'd have to potentially wait a long period of time for markets to come back down below all-time highs. You don't know when the next crash or downturn will happen. You don't know how deep it'll go. So trying to use that type of strategy is generally one that the opportunity risk outweighs what you might make by simply waiting to get a better price. But I think what I really want to highlight is what has happened in the stock market, particularly in this chart, the S&P 500. What have future returns look like after markets hit a new all-time high? And so our friends over at DFA had compiled almost 100 years of data going all the way back to 1926 for the S&P 500 that shows what are the average 1-year returns, 3-year returns, and 5-year returns for stocks of the S&P 500 after a new market high was hit. And the average 1-year return was about 14%. The average 3-year annualized return was about 10%. And the average 5-year annualized return was about 10%. And so what that tells you is that's actually fairly similar, particularly on the 3 and 5-year returns, to what the long-term return of the S&P 500 has been anyways. So the data is telling us that just because the stock market has hit a new all-time high does not mean we should be negative about the future or what might happen with stock prices going forward for the next 1 year, 3 year, or 5 years. The data doesn't support that you should take a pause and not invest any cash that you intend to invest at that moment just because stocks are at an all-time high. So I think that's important, especially given the big run-up that stocks have had over the last 12 months, which has been one of the best 12-month rolling periods in decades, literally in decades, the best that 12-month period ever seen in my 14-year career. So that, sounds like someone could give pause and say, well, geez, boy, what's that spell for the future? Have all the returns been pulled forward already? And I think the answer is no. I wouldn't bet on that. The data doesn't tell us that is likely to be the case. And the last time we saw a 12-month rolling return anywhere near as high as this was going from March 2009, which was the bottom of the 2008 crash, the financial crash, to March of 2010, which was a fantastic 12-month period. And what happened after that? Well, the rest of 2010 finished fine. 2011 was a little bumpy, but then 2012 was fine. 2013 was great. We had several really good years that came right after that phenomenal 12-month period. And that, don't get me wrong, that's just one example. But I think the data going back for the last 95 years tells us there's no reason to be negative about stock market returns going forward just because they had a really good 12-month period over the last year. So that kind of recaps this quarter's performance and what's happened in the markets and what's going on. Hopefully you found a lot of that information useful or providing some good perspective on what's happening and what we're thinking. One additional thing I would want to add is that it is that time of the year. I know the government has extended the tax return deadline till May 17th. But if you've wrapped up your tax return already, please, please, please send us a full copy of your 2020 tax return and your state tax return. It is extremely useful for us and our advisors to review those tax returns to ensure that we're doing everything we can to lower your tax bill and save you money on taxes, which of course virtually everyone likes because that means more money left for you to enjoy and spend on whatever it is you see fit. So with that, thanks for joining on this first quarter 2021 commentary, and we'll see you next quarter.